Hi, I'm Peter Rose, founder of Longwood Currency Trading, and the topic of how to use moving averages when you're trading Forex is a constant theme that runs throughout the educational resources that are out there. And again, as you know, if you've listened to most of my stuff, I'm just not a fan of indicators. And that just doesn't mean it upsets my bowels. I'm from a standpoint of having a degree in physics and a large amount of mathematics behind me, and having written thousands of lines of simulation computer code because I was a software engineer for 33 years. I sort of understand how these things work and whether they work or they don't work and what they're used for and not applicable for. And unfortunately, most of the folks out there that are teaching trading don't really understand moving averages. They don't really understand their proper use or where they would be applicable in their use. So I thought I would move my chair around here a little bit. I thought I would try to break this down a little bit for you and lay out 4 uses or times when moving averages might be appropriate. But that doesn't necessarily mean that you use them for that. You won't get that until maybe the end of the as we move a little bit further into the video. But moving averages are basically used for past price action. Take a look at what happened back then. They're used in trading for crossover moving averages systems, like where a fast 8 crosses a slower 21 or 55. They're used as support and resistance in a trending situation where the price is, for example, moving up and it retraces back and hits down on that on a moving average below that. Whether it crosses it or not, acts as somewhat of a support or resistance level. And then finally, moving averages are used as confluence in conjunction with other indicators. And I think that's probably where we're going to move toward this discussion ultimately. But past price action, crossover, support, resistance, let's take a look at those. Moving averages are just what happened in the past. They have absolutely nothing to do with what's going to happen right now or in the future. The longer the moving average, you go out to a 100-period moving average and say, well, you know, if the price action is going to do what it did 100 periods ago, let's say you're on a 1-hour chart. That's 100 hours ago. And averaged out, that average would be right in the middle of that. So 50 hours ago, basically 2 full days of trading, is not what's happening right now. It's past price action. It's what happened in the past. Why would that moving average and a 100-period moving average have any influence over what the price is going to do right now? You know, if you look at the daily chart, for example, and the daily chart has been going up for the last 8 days, so you have a pretty good candle process of rising prices. Does that tell you what's going to happen in the next 10 minutes, the next 15 minutes? No, it has nothing to do with that. If you want to trade with a risk of a 2 ATR on a daily chart, the thing might have an 80 pip ATR. So what are you going to do? 160, 200 pip risk? You're shooting for a 400 pip gain, and the thing goes 150 pips against you. What are you going to do? You're going to wait that out? Because there's no guarantee that that's going to hold. That you have to understand that price action is not created by you sitting at your at your computer keyboard and typing orders in. It's large institutions, hedge funds, banks that are fulfilling their client orders. So, over the past 6 weeks, we've had 5 major institutional traders trading $22 billion worth of orders going back and forth between Great Britain and the United States, let's say. And so you've got this moving average that's reacting to all these price movements as these guys get their client orders squared away. What happens when they stop doing those orders and you're trading with that trend, banking on that moving average holding its continuity and credibility? The guy's done. The price collapses. You're going to wait 200 pips for that to happen. Go, oh, well, shit, I went through the moving average, so I probably better get out. I don't know that that's a viable use of a moving average, because it's past price action. It's what happened in the past. Moving averages are used in these crossover systems. Oh, look, I've done extensive computer simulation of this stuff. And if you look at a graph at where the moving average crosses, the actual price, let's say you were going up, the fast moving average crosses up above the slow. And so the place where that happened as far as the price is not here where the cross happened, but it's down here somewhere. That's where you're getting the order, because there's a lag in the time in the information. So by the time that those moving averages begin to roll over and they cross going the other way, price is way up here. So you've got price is diffused between those two crossover points. And I mean, if you have huge trending systems with hundreds of pips between them, you won't get chopped out too badly. But if you're down on an hour chart or a 5-minute chart and you're just doing straight crossovers, the computer tends to be able to pick those up fairly well. The simulations that I did a matrix simulation, 3 cross 8, 3 cross 13, 3 cross 20, 3 cross 28, 3 cross 32, 3 cross 55, 8 cross 13, 8 cross 22, 8 cross 20, blah, 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 all those permutations or combinations of crossovers, and taking a look at, well, which ones were best or which ones performed better. And depending on what price action was doing at the time, whether the price was trending, whether the trend was a long-term trend or a shorter-term trend, for example, swing trends, or whether you were looking at 5-minute charts or 1-hour charts, different crossover pairings did better under those different conditions. How do you teach a robot how to do that? How do you manage that when price is trading so vibrantly between the checkpoints, the cross points, on whatever time frame it is that you're trading? The crossovers are not, it's just not viable. The computer can pick it up, can go through all the price action, find the pairing that went, well, this is what I did. It went through them all, hundreds and hundreds of thousands of calculations, found the best that had happened over the last 172 periods, which is about all prices I could fit on my computer screen, so I could see this stuff. And right when that cross would happen, or right when I had other conditions that would say, well, it's going to happen, boom, I'd get in and I'd take that, and then when the cross happened on the other side, it was the same thing. And so I was getting more of the spread between where price was during those periods, and it worked out pretty good until you went into a chop, and then it just ripped the shit out of it, and it didn't do very good if left to its own. And price does that. I don't know, price trends 30% of the time or something, and it chops the rest. So I don't think that crossover systems are valid. They're viable for other things, a part of the confluence, for example. The moving averages can be used themselves as support and resistance. For example, you have horizontal support and resistances where you've had accumulations of limit orders and execution of market orders at that time, where a bank is transacting a big block of their client orders in those areas, and so you get a lot of churning going on of orders, transactions taking place. So if the price drops down out of that, and then the bank works its way back up into this mess, you've got all those guys that get picked the wrong way. They've got their stops up in there, and then you got the other people who think, well, now it's going to go up, and so their orders are in there, and so it acts to absorb that stuff. So those are support and resistance lines. Well, moving averages will do the same thing, because remember, the moving average is what the average of all the past price action over the period of the moving average has done. And so it does act to a certain degree as a support and resistance for that price action. But again, there's a thing in physics called Hooke's law. It has to do with a spring. And when you pull a spring apart like this and let go of it, it snaps back to its mean area. And so if you watch price as it's going up the chart on a rising scenario, the price is going up on the chart like this. The moving averages are also under that, and they're going up. But the moving averages aren't going up as fast as the price. The moving averages are going to lag down here, and the more momentum, the steeper that the arc of the candles are moving, the further the price gets away from where the moving average is. So that eventually what happens is that the moving average doesn't catch up with the price. The price runs into one of these consolidation areas and goes boom, and it collapses back to that moving average, which is called regression to the mean. That's the mathematical term for it. It's the regression to the mean. And Hooke's law sort of describes that, and there's a lot of people that use that in their trading. They say, well, the distance between where current price is and where the whatever period moving average you want, an 8 period, a 55 period, doesn't make any difference, has gone a percentage or a pip value such that it's going to run into problems, and Hooke's law is going to pull it back. Well, Hooke's law has nothing to do with it, and your view of how much distance there is between current price action and the moving average is subjective. It's not objective. I'm 40 pips apart. Is that too far? Well, no, because maybe it'll go 60 pips. Is 10 pips too far? No, it's going to collapse back at 10. You don't know. You can't base it. You can take a subjective view at it, but you can't use them for support and resistance. And that comes to the final part of that was the confluence. Confluence in using, if you just look at the moving averages, what was the moving average doing in the past? And you can look at the slope from a mathematical standpoint. We talk about the slope of the moving average being the average of the slope of price action. In the most of the trading platforms that you have, your moving average is based on the closing price, which I don't like. I don't agree with that. I was always, when I was using TradeStation, I would use the lowest price. Whether the price was going up or going down, that was the moving average. I wanted the moving average of the lowest price. So you look at that price action, regardless of where you're calculating that moving average from. You look at that past price action. What has it been doing, and has that moving average a stable momentum in the direction it's going? You don't want it peaking. You don't want it shooting up, because then you've got the natural law of Hooke's law in place, the natural law of regression to the mean taking place, and that's a very subjective view. So you just don't want to get in and trade during those times. Or you may be looking for a congestion point and speculating that you may get a reversal. But that has nothing to do with the moving average. But so you look at what the moving averages are doing, have been created from the past price action. Then you look at the periodicity of the crossover things. When has those crossover events taken place? You know, these prices tend to move in waves. You know, you go up, rising prices, and then it comes down, and so you need to take the crossovers as wave periodicities in that. Folks would call that swing trading, right? You pick the high and it swings off the high. There's certain things that you look for. Maybe a crossover of a moving average is one of those things that a swing trader is going to look at in determining whether to take the trade or not. But you're combining the crossover information that you have with the past price action. You're not trading based on the past price action. You're not trading on the crossover. What you're doing is you're getting confluence between those two. And then where is the moving average in relationship to where the price is? If it's way, way, way far away from, if the price is way, way far away from the moving average, then you could get a regression to the mean. The crossover could indicate a violent regression to the mean. Past price action could say, well, you know, you have these wave structures, and maybe you're ready now to have a change in the direction. Those are all valid uses of the moving average. You don't just use the moving average. You have to use the theoretical implications of multiple moving averages over perhaps multiple time frames to determine multiple cyclical movements of the price action itself in order to make a determination as to what you're going to do. And there was only two things that you're going to do. You're either going to get in or you're going to get out. So you need that confluence of the moving averages. But it goes even beyond that, because confluence between the moving averages, you're only getting confluence among the same indicator, because the moving averages are telling the same story. They're singing the same song. The fact that you get confluence among the different uses of that moving average is not enough confluence to make a trade decision in itself. Is it NFP? What day of the week is it? Is it what time of the day? Is it noontime somewhere where the traders are going to lunch? Is it 8 p.m. at night? Are you trading an Asian session on the East Coast of the United States? What other factors, what other indications of price action are there out there that can be used together? And this really builds a very complex methodology for trading, doesn't it? I mean, you can see that. And one of my big bitches about the educational process of currency trading is there's too much information. And the information is based on all these friggin' indicators. There's too many of them. You know, if you just had 5 indicators, there are 325 different permutations that you could organize those 5 indicators in. That's just a shithouse too much of stuff to think about and look at. You can't make a decision from that. You know, Curtis Faith talks a lot about that in his book. I keep quoting his book over the last few videos, but it's been very true. His statements are true. You got to use your gut. You have intuition, which is based on the information, and you have your gut, which is based on how you feel about your past experience within the market itself. And that brings up another topic of, well, are you trading 15 different currency pairs, or are you just trading one? I trade one and only one. I don't look at any others. I may change and look at another pair, but only to pick up a different time frame. And it certainly wouldn't be a USD-based pair. It would have to be something else, because I don't want it tied to USD. Because if I'm looking for an Asian thing, why, you know, I want to look at pairs that are actively being traded over there, because you need momentum to trade. moving averages are a good indication of that momentum. So you could use the moving average for that. We've talked a little bit about that before. So anyway, those are how you would use moving averages in your Forex currency trading. You don't use them just to say, I'm gonna pick up a trade when a fast MA crosses a slow MA. Oh, and by the way, would you be using SMAs or EMAs? You know, you got to know the difference between those two things. You don't want to complicate your life. So what I do is I take, and I have 3 moving averages that I have on my charts, very little else. I have moving averages and some support and resistance lines at the daily level, because even though I'm scalping on the 5-minute chart, I want to know what the parameters for expectation of a daily movement is. So I can see from a percentage of a day's trading, where is current price action at? I use that. So it's a mix of a lot of things that go into determining your take points. If you try to look at all these things as individual pieces, 325 different pieces of information, it's too much. What you have is you have these things that are up on the chart, and then you have to have enough experience in the trading to look at that and go, yeah, all the things are lining up. You don't say, oh, the fast MA's crossed this and this has happened. You don't have a checklist, like an airline pilot, a checklist of stuff before he takes off. You can't do that in trading. It has to be more, as Curtis Faith would say, your gut based on your intuition is what needs to be done. I mean, maybe I'll do a video on that at some point as well. But for now, thanks for watching. My name is Peter Rose, founder of Longwood Currency Trading. Have a great day and have a great trading day.